All right. Hey, everybody. Thanks so much for hopping on. This is a new system for us, so we've got some background music going. But bear with us as we learn this new system. You should be able to see a option for a chat, and by doing that, you can come in and chat questions to the whole studio. And then if you have any specific questions, you can also shoot an email to us. If you just want to send an email to me, which is Nate at goodmancpa.llc. And while we're getting started, I just wanted to run through what today's session is all about. Hopefully, you guys can take away some value from this, explain a little bit about who we are if this is your first time interacting with us. So today we're talking about leveraging Trump's new legislation, and the goal here is that you'd be able to save some money on taxes. Tens or hundreds of thousands of dollars in taxes would be incredible. This is the One Big Beautiful Bill Act, also known as HR1 is the official name. And we're going to go through a couple different items. With me today is Drew Kitchens. He's one of our client CFOs. And then I am the founder at Goodman CPA. We specialize in working with folks in the direct care and healthcare space, be able to save money on taxes, get better financial clarity, and provide this type of content as well to help educate people on opportunities that they can take advantage of. So this is our agenda for today. We're looking at understanding the new tax landscape, looking at individual tax benefits and opportunities. We're going to be looking at business tax advantages, looking at health and medical savings strategies, depreciation and asset expensing, some energy credits. This one has some actions that are required before December 31st. And we also had one that was September 30th we'll talk about, but that deadline's now passed. And then look at implementations of strategies and any next steps. I am going to switch, instead of presenting it in here, I'm going to move it over to PowerPoint because I see it's getting kind of merged together there. It looks a little funny. So let me pull this over here real quick. Drew, is that coming through okay on your end?
I'm still seeing the same screen.
How about now?
Yeah, I can see it now.
Okay, there we go. That looks a little cleaner now. Awesome. So as we always like to say, this information is based on enacted legislation that became law on July 4th. Some provisions are still requiring some Treasury and IRS guidance for implementation details. So we're trying to give you as much information as possible, but there is still a place where clarification is going to be needed. And so some things that we say today, the Treasury or IRS may come out with additional regulations and ways to implement these and how they'll actually be applied, as well as when court cases come out and people start to fight against this. We'll see how these play out as we go through. But this will be as of our understanding today as we read the bill. So let's talk about understanding what this new tax landscape looks like for individuals and business owners. At our firm, whenever we're doing firm development, we always like to play this game. Drew owns a business. We call it Drew's leaf raking. He's very good at leaf raking and his business blows up. And so now he's trying to find ways to reduce his tax liability because we're in fall season now. And so the leaves are starting to fall. It's his busy season. He's got to get out there and start raking leaves. So he might develop a new tool for his business to rake leaves. He might hire some employees. They might even spin a screen around so that they offer, encourage their customers to give a tip. So what would that look like? So if you're a business owner, this will we'll have a lot of stuff in here. If you own a direct primary care practice or a counseling practice, and the only other thing I did want to do is we might have people in here that are unfamiliar with what the direct care model is. If you're running a DPC practice, I'm sure you're well aware of what your model is. But the direct care model is built to restore the relationship between the doctor and the patient. This model has made a huge difference on my own life and my family's life because now we pay a monthly fee to our family doctor. We can go see him whenever we need. He's available via text. And in the end, what is happening is we're starting to see people have better health outcomes because they're interacting with a direct primary care doctor. So you may be also in the direct care space if you're offering direct specialty care, direct dental care, direct vision care. It is basically the model where you are directly establishing a relationship with your patients opposed to having agreements and authorizations through your insurance companies. So we love to work with these folks. You guys are changing the landscape for health in America, and we want to make sure that you can receive good tax advice and also build sustainable business models. So let's kind of dive into what the new tax landscape looks like. So, what does this mean for you? The triple B, we'll call it that to shorten it, or HR1, represents one of the most significant tax legislations we've seen since 2017. It's a very comprehensive legislation. It affects virtually every aspects of tax planning for individuals. And there are some really big impact areas that we'll dive into, but there are permanent tax rate reductions, there's enhanced business deductions, there's new savings opportunities, there's strategic timing for your considerations before the end of this year, and then opportunities for some immediate implementations for many of these provisions. So I'll let Drew talk through a little bit of these individual tax benefits and opportunities for individuals.
Yeah, like Nate said, we'll kick it off talking about your individual tax situation and really starting with the rates. And so, with the tax rate changes from this legislation, you won't see a dramatic decrease. And so, what this administration has tried to do is they're trying to lock in a lot of the changes that were made back in 2017 that were set to sunset at the end of 2025. And so, as a part of that, the 10% and 37% brackets that were kind of reduced, the rates were reduced to in 2017 are now permanent, right? So there's no guaranteed increase next year or next year after that. So, for example, right, with the highest rate being 37%, without this permanent rate increase, the rate was set to go up to 39.6% next year. And it's estimated that as a part of this legislation, the Tax Foundation did a study, and they estimated that without this permanent rate lock-in, that 62% of tax filers would pay more in tax next year had this not happened. And so this is less of a immediate tax savings tool, and it's more so protecting you from tax increases in the future. And so those rates are set to be permanent, and the only adjustments to those rates that are on the horizon are increases in the income thresholds for each bracket. That will just be inflationary, right? 2-3%. Another big change is the standard deduction. Again, back in 2017, the standard deduction was raised pretty significantly. So starting in 2025, that's all increased slightly again, and that's been made permanent. So there's no chance of those higher standard deductions reverting. So if you do take the standard deduction and you don't itemize, right? Itemized deductions being things like charitable contributions, medical expenses, taxes, and things like that. If those expenses for you don't exceed this threshold, then you'll receive this benefit. And so for married couples, that's up to 31,500. The big change in this legislation is a temporary boost in that amount. So again, if you're married, an extra $2,000 will be added on top of that standard deduction for the next 4 years, providing you an extra little buffer there to save on taxes. Again, going back to 2017, there was an expansion in the child tax credit. That's gone up a little bit, and there's no more concerns of that expiring. That's been made permanent. So per child, if you have 3 children, again, this would be $6,600, and it could be multiplied up. But for each child that you have, you get $2,200 in a tax credit. Again, that's not a deduction; it's a credit. So that's a dollar for dollar tax savings. And so you can kind of take that to mean if you made $100,000, the first $2,200 of tax that you have, you would not be taxed on, right? And so what the $1,400 refundable portion means is you have to have tax to absorb the credit. And so say that you have a ton of deductions this year, you've invested into the practice, or this is your first year opening your DPC and you have a lot of expenses, but you do have children, a portion of this can be refunded to you without you having tax to absorb that. So say you have a loss in your practice that flows to your personal tax return. In that situation, you wouldn't have any tax, but you could still get a $1,400 refund per child starting this year.
So if we
Another
took this
change
in,
that's only relevant for folks It's not too relevant for folks, but your children do have to have social security numbers. That was a recent change that the House made when it came to them from the Senate version.
Yeah, so if we take this and make it practical, right, and say, Drew's leaf raking business, Drew's been crushing it, made a ton of money off of his leaf raking business, found himself a wife, and they got married at the beginning of the year in January, and then they had a kid. They got pregnant. Now they're gonna have a kid before the year is over. He's now moving from being a single filer, having a $15,000 standard deduction, to a $31,000 standard deduction. So, in order to itemize his deductions, he would have to have more charitable giving, more mortgage interest, more medical bills than the 31,500 to be able to choose to itemize over taking the standard. And then he's also getting, for these next 4 years, this boost on that deduction of an extra $2,000. And on top of that, so let's say he made $100,000 from his leaf raking business, all other things excluded. If that pulls through, he's got an adjusted gross income of $100,000. Instead of him having taxable income minus the 15,750, he's now going to have taxable income minus the 31,500 plus the 2,000, so about 33,500. So we've now reduced his taxable income down to about 77,000 because he got married. And then if we took and assumed a tax of, let's say, $7,000 or something off of that amount, he can now reduce his $7,000 tax bill by this $2,200. And if he had paid anything in, he would get a refund if he overpaid. If for some reason we totally wiped out your taxable income, then you're going to get $1,400 back, even if you don't pay anything in. So great work on your leaf raking business and being able to pull in that extra cash. And you want to talk a little bit about deductions for seniors? May have some that this applies to.
Yeah, this is a new enhanced bonus program. So for the next 4 years, similar to the extra $2,000 that married couples get on the standard deduction, seniors. So if you're 65 and older, you get an extra $6,000 added to your standard deduction for the next 4 years. The main caveat there being an income qualifier, right? So anything over $75,000 for single filers or $150,000 for married couples that are filing jointly, that excess, the credit is going to be reduced by 6% of your total income, right? So if you made $200,000, the credit's going to be reduced completely, right? So the idea being that if you have over $150,000, 6% of your total income reduces that. So the whole idea there is to try to make this a stimulus for low-income folks and folks that are, in lower tax brackets, and not shift a lot of these benefits to folks that, or what the IRS considers high earners.
So now we talk a little bit about what kind of deductions are going to be out there on top now for folks that are considered working families. So you want to dive in a little bit on the game-changing deductions for working families.
Yeah, so one major change in this legislation is the no tax on tips. I'm sure everybody's probably heard that in the news, the no tax on tips, no tax on overtime. And so that does come with a $25,000 annual limit. I've seen some clients asking, can I just start taking tips, right? Like if say I'm a DPC practice, can I start taking tips? The IRS has kind of restricted this and kind of foresaw people trying to play the system that way, and um, they've kind of made it out to be where you have to traditionally receive tips, right? Be it a restaurant, a bar, a hair salon, something like that, where you would traditionally receive tips. So this isn't as necessarily as relevant for, say, a DPC practice that's collecting a monthly fee for their services. So this was largely a benefit to the employee of these types of businesses. And so, say that you're a waitress at a restaurant, right? And up to $25,000 of tips that you receive, you can exclude from your income. So it's pretty substantial for folks that are in those industries. Again, trying to exclude high earners, the IRS is saying that over $150,000 or $300,000 for couples, you can't get this benefit anymore. It also excludes anybody that's operating as an independent contractor, right? So you need to be a W-2 employee of either a traditional service that does receive tips. This isn't something that, we work with our DPC practices. This isn't something that we necessarily are looking at for their practice specifically. But a lot of our DPC practices, they do have children that are teenagers that are working in restaurants, and they're doing those sorts of things as they're in school and college or whatever. And so this is something that we want to make sure they're aware of, whether we're doing their children's tax returns or whether this is just some information that they pass along, because it can be a substantial saving on that $25,000.
So in the leaf raking business, you're not charging a whole lot of tips.
How much?
uh, then let's talk a little bit about the no tax on overtime. I think this is an interesting provision.
Yeah, it's a similar model as the no tax on tips. And so this only applies to the extra portion of income. So say you work 40 hours a week and you get time and a half um, over that time and a half premium, you're not going to pay tax on that up to $12,500. Again, if you're married, it doubles. And so that's $25,000 for married couples. This can be relevant for some DPC's employees if you do have some hourly employees that end up working overtime and fall into those categories. Um, that do receive some overtime, that can benefit them, not having to pay tax on that excess premium, that time and a half overtime. But this is great. This is now set to expire December 31st of 2028. So we have around 4 years of benefit here. And so we'll just have to wait and see if that gets extended. But in the meantime, if you do have any employees that you do pay overtime to, or again, if you have children or someone that's in a position that they receive overtime, this can be a great tax savings tool. The one thing I do want to highlight on, especially the no tax on tips and the no tax on overtime, is when you think about large organizations, this is stuff that can kind of be automated through a large payroll provider or something like that. But if you're looking at small businesses, say that your child works at a small local restaurant or a coffee shop or something like that, or you have an employee that works for you that does receive some overtime, this is important for you to be aware of. It's not some sort of automatic provision, right? We need to make sure that this is set up properly in your payroll software and this stuff isn't being taxed. Otherwise, this will continue to be withheld and they won't receive a refund until later in the year, and we'll end up giving the IRS a interest-free loan for that period of time. So this is something that we need to be aware of if that's something that you feel like applies to you or your children.
Yeah. Then the next two are like the no tax on car loan interest and also Trump accounts. So we'll talk about
Yep.
those.
Yeah. So the no tax on car loan interest, this is completely new. This hasn't been something that's been allowed previously. The real key is you can kind of view some of these provisions and see what the administration and what Congress is trying to do here. They're trying to stimulate the purchase of vehicles inside the U.S. And so part of this provision is it must be a new vehicle, right? So completely new. This isn't new to you. This is completely new, a brand new vehicle that you purchased that was assembled in the U.S. If you purchase a vehicle and finance a vehicle that was assembled in the U.S., new, um, completely new vehicle, you can write off up to $10,000 per year in car loan interest. Um, Previously, interest deductions have only been allowed for real property and and home equity lines of credit and things like that. But this is now being expanded to car loan interest for vehicles assembled in the U.S. Similar to the other provisions, you can get back for a second. Similar to other provisions, there is an income limitation here. So um, if you're married filing joint, if your income is over $200,000, that would start to phase out. So um, anything below that, you can take advantage. This is also a completely new thing, the Trump accounts, and so I would advise this to anyone who has children, specifically children who were born after January 1st, 2025, so very young children. The reason is we're all familiar with IRAs, and IRAs are a great tax savings tool, a great retirement tool to help you build wealth and put things away for retirement. But that's usually out of reach for young children, right? Unless they work in your business or you hire your kids, and we can kind of work with that. Children don't have earned income. Most of the time they're just being kids and they don't have a job, and that's one of the main qualifiers for having an IRA, right? So a Trump account is kind of like a makeshift traditional IRA, and so this is a way to get retirement savings into accounts for children before the age of 18. So the main qualifier is um, being below the age of 18. So if you started this for your child, and if your child was born before January 1st, 2025, you can contribute to this annually, and there's a $5,000 annual contribution. That's an after-tax contribution. And so you can contribute to that account and then it can grow tax-free. No withdrawals. One of the caveats here is no withdrawals are allowed for any reason before the child is 18. And that's meant to protect the child, these funds for the child, so that the parents can't hit a financial hardship or something and try to withdraw the funds. And so the idea is to protect these funds and allow them to grow tax-free for the child. And then once they're 18, it converts to a traditional IRA. And so at that point, the child can withdraw from the account. There would be the 10% penalty in the ordinary income tax prior to the child being 59 and a half, similar to the traditional IRA rules. But with that, there's some caveats. They can withdraw for education expenses up to $15,000 for their first home, down payment on their first home. And then one of the new things is a small business startup cost, right? So say they want to start a business and they need some seed capital, they can withdraw from this account to do that. The thing I mentioned about children who were born after January 1st of 2025. So for all of those children, if you start an account for them, the government and the Department of Treasury will deposit $1,000 into the account for you. And so by not setting up this account, even if you don't want to use it as a retirement tool for your children, even if you don't want to contribute $5,000 annually, by simply setting up this account for them through the Department of Treasury, you get $1,000 from the government to grow tax-free for your child. And that starts in July of 2026. And so for children born after January 1st, 2025 and on, you can start this account and they will get $1,000 from the government. And they will now have this retirement account that they can access when they're 18, or they can let it continue to grow until they are 59 and a half.
So you're telling me as your leaf breaking business is taking off, newly married, new kid on the way, as soon as they're born, you're gonna open up a Trump account. You tell your wife she needs to go start collecting tips and work a
Absolutely.
lot of overtime, and then you're gonna take
That's
advantage
it.
of each one of these, right? That's it.
That's it.
Awesome. Well, let's talk a little bit about some state and local tax relief for high earners. And so the big thing here is the SALT cap, which is your state and local tax deduction, has been capped for very many years at $10,000. And most people hit this either with their real estate taxes or their state income taxes. They'll really quickly hit this if you're over even like 150,000 or $100,000 a year in income. So they've now raised this limit to $40,000. So your real estate taxes, the state income taxes you pay as an individual, um, any sort of like state level taxation, you can deduct that or count it towards your itemized deductions. And like we talked about before, the standard deduction has gone up to about 33,000 for married. So if you just had $40,000 in state taxes, you would immediately clear the threshold for standard deduction and be able to start taking an itemized deduction. And what that is doing is it's reducing your taxable income. It's not reducing your tax bill. So it not dollar for dollar anyways. By reducing your taxable income, you're marginally reducing that tax bill that you're going to owe. But this is a large provision to give a lot of relief for those people that are in high tax states. The minimum protection of $10,000 is for most taxpayers. This does phase out for very high earners. So if you're over what they would consider a very high earner is $500,000 in income, it goes back to that minimum protection. And then this is temporary through 2029, and then it reverts back. So kind of like we're seeing the 2017 legislation becoming permanent. If the next administration wanted to try to make this bill permanent and make the salt cap permanent, they would probably come in with another bill, kind of like they did with this one, to make some of these things permanent so they don't sunset in 5 years.
Yeah. I'm going to jump in on that, Nate, just for a second. So with 2017, in 2017, when that deduction limit came down to $10,000, it was previously unlimited. A lot of the states, so nearly every state that has an income tax, has come out with what's known as a pass-through entity tax. And so to kind of circumvent this limitation, states have allowed you to pay your state income tax at your business level. So say you have a DPC practice, this tax is an S corp. That S corp would pay the tax that was generally paid at the individual level. And by doing that, you were allowed to take that state tax deduction as a business deduction on your business tax return, on your practice's tax return. And that was a way to kind of get around this $10,000 limit. And so what the IRS is doing now is they're saying, hey, we know everyone is working around this limitation anyway, so we're going to raise this limit to kind of keep that from happening, or make it a little easier anyway for you to do it. But for the clients that work with us, the DPC practices that work with us, this is something that we monitor, because even though this deduction limit has raised, say that you're in your situation, you're going to have state income taxes, and that's going to allow you to take a $34,000 deduction instead of the $33,000 deduction that you would get under the standard deduction. In that situation, it would make a lot more sense for us to set up a PTE election for you through your state, because then you can kind of double dip. You could take the full state deduction still, and also at the same time take the full standard deduction. So it allows us to kind of duplicate the benefit there, and that's stuff that we work with. And the same thing goes for our clients that have over $500,000 in income. With the PTE, we still have ways to get these deductions on the returns for those folks, but that's just something that we have to optimize and work through with our clients throughout the year.
So now what we're going to do is we're going to turn our attention to businesses for the next 20 minutes here. And if we have some time here at the end, if you have questions as we go through this, feel free to put a comment with your question, or you can shoot me an email, nate@goodmancpa.llc. We'll make sure we'll try to leave some time here at the very end to get those answered. But let's talk a little bit about the business tax advantages that have been passed with this OBBB. So the first is there's an enhanced pass-through business relief. They have made now permanent the 20% deduction for business income. And what this was called, if you talked with your accountant, they call this QBI. It's qualified business income. Our folks in the direct primary care space are considered a specialized service business. And so there's other thresholds and phase outs that happen a lot sooner for people that are in the professional service space. But it is still, especially for startup DPCs that have a lower taxable income in their first couple of years, they get to take advantage of this deduction, and they now have a minimum deduction in place as well. So the easier income limits. So what this means, 75% of excess income is going to reduce your limitation instead of totally eliminating them. They've instituted a minimum $400 deduction for people who are actively involved in their business. So this is going to be the folks in the direct primary care space. You're actively working in your business every day. And then they've also raised the thresholds, $50,000 and $100,000 to $75,000 and $150,000. The other big one is there's also a massive estate tax relief. And so in this bill, we now have a $15 million exemption per person. So if you're married, your estate exemption is going to be $30 million total. And there's permanent protection. So there's not a cliff that was going to happen in 2026. They've now permanently enacted this $15 million exemption. Most people that we interact with don't have to worry about this because the limit is so high. But if you grow a DPC practice and you have multiple sites and the value of your business starts to grow close to that $15 million line, then you start having some issues with estate taxes that you would want to plan for. There's also inflation adjustments, which reset to 2025 as the base year. So this year will be 15 million, and every year you'll see that exemption slowly go up for inflation. The good news is if it had clipped and went off and we had a reset in 2026, then if your business exceeded 5 million, you would start to have massive estate tax issues. And that tax bill can be very large. I mean, we're talking 40% of your estate or larger would get taken up in taxes. So this is a great benefit to business owners because your business is valued at the date of death for your estate. And you can grow a very successful business, especially as we're seeing DPC continue to build and grow in America. And then we're going to talk about, I'm going to talk about the 100% bonus depreciation, and then Drew's going to talk a little bit about more enhanced write-offs for large equipment. But they have extended this 100% equipment write-off So we can now, if you were to go out and buy a piece of equipment, let's say an exam table, or chairs and furniture for your office, instead of having to spread that out over 5, 7, 15 years, we can now take that immediately again against your income for the year. So if we have a really big income year, something we'll do with some of our DPC practices is we will talk through what types of assets do we need to buy. We never want to make the tax tail wag the dog. But if we need to buy equipment, we may speed up those purchases in a high income year or delay those purchases to the following year, especially as we're here towards the end of the year, and purchase them when we need them. So this is for any assets that were purchased after January 19th, 2025. So if you've bought assets this year, you'll get to take in the benefit of 100% deductions opposed to having to wait over the course of time to do that.
Yeah, so what Nate was discussing there is what's known as bonus depreciation. And what I'm talking about here is what's known as Section 179 depreciation. And so the bonus depreciation that Nate was discussing had recently phased down to 60% and was set to go to 40%. And so now that that's been raised back up to 100%, the 179 is a little less relevant. The bonus depreciation is much easier to qualify for, and it's much more advantageous. And so for folks that purchase equipment that purchase less than $2.5 million worth of equipment, we can take 179. And so bonus depreciation that Nate was discussing is eligible for anything that has a tax life less than 20 years. And so that's going to be anything from land improvement, parking lot upgrades, any sort of interior upgrades to your facility, any sort of leasehold improvements, office build out, anything like that. It's also going to include, exam tables, any sort of cabinetry, desks, and equipment and things like that. Where we're going to run into 179 being more relevant for you is if you have, if you're in a state that doesn't allow you to take a bonus depreciation deduction. So more states allow 179 than bonus. So if you took bonus depreciation on something at 100%, you would get a great federal tax benefit. But if your state doesn't allow bonus depreciation, then you wouldn't receive any benefit at the state level. With certain states, 179 is allowed. So you could receive both federal and state benefit. And that's something that we would have to optimize for you based on your specific state and your situation. Another place where 179 is relevant compared to bonus is for things that bonus isn't allowed for. And that's going to be a new HVAC system on your building, a new roof, a new sprinkler system, like a fire protection sprinkler system, certain security type systems that are built into the building. All of those things would be eligible for 100% expensing through 179, whereas bonus wouldn't allow those things. And so if we were working together, the way this would kind of work is kind of optimizing between the two, right? Because you can take certain assets for bonus and certain for 179. It's not a one or the other scenario.
Awesome. And now there's also been some extensions on business credits or changes to business credits as well, or overall credits for business owners and individuals. So you want to just touch on the
Yeah.
credits that have
Yeah.
changed?
So the main thing is the child care credit. And so for any child care support that you have, that is now up to 40%. So you can get a 40% credit on those expenses. It was previously 25%. And if you're a small business owner, less than 29 million in revenue, which most DPC practices we see are, you can get up to 50% credit for that. And there's now a higher limit for that phase out. And so that's around $5,000 a year for most employers or $6,000 a year for small businesses. And so this is great if you provide benefit to your employees in this way, if you help support them in their childcare. I know it's getting more and more expensive all the time. I have a 2-year-old. I know childcare is pretty insane. So any sort of benefit you provide to your employees in that way, you can now take a credit for that.
So kind of like a practical example, right, would be if you've got your leaf breaking business and I come on and work with you. I've got 3 kids and you say, "Hey Nate, I'll pay you, $20 an hour, but also I'll give you an extra $500 per month to pay for your childcare." We'll actually pay directly for your childcare expenses.
Mm-hmm.
Um, that $500, you're going to get a $250 credit for that $500 that you're paying towards your employees. Is that right?
Exactly. Yep.
Yeah.
And again, a credit being a tax dollar for dollar reduction rather than a rather than a deduction, a credit would actually save you that amount in taxes, dollar for dollar.
Yeah. So as you're kind of evaluating benefits, right, the tax code is often written to incentivize business owners to provide certain benefits and things to their employees to stimulate economic growth. And so one of the things that holds people back is the cost of childcare. And so being able to incentivize this for you as you kind of look at your benefits packages, not only do we have the credits for retirement contributions and those types of things, getting a credit now to say, hey, I've got a bunch of staff members that have young children. This would be a huge benefit to them if they were to get, if I were to help them pay for their childcare. And on top of that, basically the government is paying for 50% of it because they're giving you a tax credit for that
Right. Yeah,
childcare
and you see this with
benefit.
the child care credit, but this is also across the board. There's probably six, seven, eight different things we could do. And with DPC owners specifically, there's a lot of times the business is growing and there's ways that they want to reward their employees. And we can, a lot of times the default is to give them a bonus, right? An annual bonus or quarterly bonus or something like that, a little extra. And so we tend to work with DPC owners to find some of these other creative ways that A, reduces the tax burden on the employee, but also provides a more tax advantageous approach for the employer as well, to get that extra benefit to them for things that they're already going to likely be paying for anyway.
So the next one's probably the biggest buzzword I think around DPC is the treatment of HSAs and medical saving strategies. And I think what we're going to talk about today is the enhancements for actually offering this benefit. But I know the bigger buzzword in HSA right now for DPCs is that DPCs qualify for HSA spending, and so that creates a lot of other clarifications that we're waiting on in terms of, does that consider it a qualified medical expense? And if so, can employers offer it as a benefit without it being taxed? Those things are yet to come, but we do know that HSAs can be spent for DPC. But this specific section, we're going to talk about how this benefit for if you provide an HSA.
Yeah, yeah, like Nathan, this is more so if you do personally or your employees or anyone has a high deductible plan and can contribute to an HSA or an FSA. So, in an HSA, the big expansions are if you're over 55, you can now contribute an additional $2,000 in catch-up funds to a single HSA, and you can also split that, right? So, say you and your spouse, you don't have to contribute that any longer in a specific sort of way, right? That can be contributed completely unevenly. The HSA limits have risen to $4,300 for individuals and $8,550 for families. And to get that full increase, as a married couple, you'd have to be below $150,000 in AGI. And so anything above that, and that number would start to decrease slightly. Yeah, and so now when rolling old HSA or FSA funds, those can roll into an HSA when you switch to a high deductible plan, and that's limited to $3,200 as a single individual or $6,400 for a family. The big change, the perhaps the largest change is now that previously you couldn't contribute to an HSA if you were enrolled in Medicare, but now seniors on Medicare Part A can contribute to HSAs as well.
Awesome. Talk just briefly about research and development, because this has changed with the OBBB. There's quite a lot that goes into R&D. We've worked with some folks to be able to take R&D credits, and I would say for those in the direct care space, the place we may see this is if you're developing a new process or technological advancement in your industry. So maybe you're kind of on the front end of everything with AI in direct primary care and you want to develop something. The new changes, we now have immediate deduction if you use domestic uh, help, your domestic payroll. So people within the US to do that research and development. Or if you're creating some sort of educational additional content that would add something new to the direct primary care space, we can look at getting benefits for that research and development that you're doing. If you are using have expenses with foreign R&D, so you're using a company overseas to help you develop, that is going to have to be spread over 15 years. Again, kind of like the credits for or the deductions for car interest, they're trying to stimulate production inside the US, and so a lot of this foreign items are getting pushed out farther and incentivizing bringing things domestically. Software development qualifies as R&D, so if you are developing some sort of AI tool to use within your practice. And then small business retroactive relief. So most of our DPCs are under this 31 million. If you have done something in 2022 through 2024, we could actually look back and get some relief if we have been spreading out our R&D expenses. There's a lot again that goes into R&D, and so if there's something specific to your scenario that you have questions on, we'd be happy to talk more about that offline.
Yeah, one thing I'll say on R&D is I've had clients over the years that, they typically think of R&D as being in the manufacturing space and it's heavily utilized there. But in addition to these expenses that were previously not allowed, there's also a credit available that can be pretty substantial for R&D. And so a lot of people in professional services tend to overlook R&D. They think, hey, I'm not inventing anything, I'm not creating anything, I'm not building software or anything like that. But R&D also, as Nate was mentioning, is far beyond just building something tangible, right? It can be your process, your way of serving patients, those sorts of things, any resources that are dedicated to some sort of new process or workflow model, all of that stuff is relevant. And so I would definitely say, whether it's us or someone else, reach out to your tax advisor if there's something that you feel like that you do differently than anyone else, and that would be likely qualifying for R&D and can provide some pretty substantial tax benefit.
Yeah, for sure. And so we're gonna do two more things here to kind of wrap up and answer questions if you have them. But and we also have some kind of sample questions that we can throw out there too if there's not a ton that pull through that might be common questions asked. But we're gonna talk about energy tax credits, and then we're gonna talk about what it looks like to actually implement these strategies. So put where the rubber meets the road, and then we'll talk through questions you guys have. So we'll kind of cap off here. Drew, you want to walk through kind of the big changes to the
Yeah,
energy credits that we see?
yeah. So the big changes that are set to expire December 31st, 2025 is well, these are actually the two that expired in September 30th. So there's no longer tax credit for the EV, so electronic vehicle. But there are credits. Nate, if you can go to the next slide. There are credits that you still have available to you. So on a personal level, if you personally are trying to do some improvements to your home, for any insulation windows or heat pumps, any sort of, if you're thinking about going solar or anything like that, I'm thinking like water tanks, water heaters, anything like that, windows, all of those things are super, if you decide to go, usually it's a little bit more expensive to go with the more clean energy version. But to do that, you can get pretty substantial tax benefit, and it's important to weigh that cost, right? When you're thinking about the increase in cost of this extra model or whatever, the clean energy model, you also have to factor in the tax savings you're going to get because it could end up being cheaper. And so you can get up to $1,200 in a tax credit for those insulation windows and heat pumps if those are installed before the end of the year. And then if you decide to do, the most common thing we see is solar panels. If you try to add any solar panels to your home, you could get a 30% tax credit on the cost of that. So that could be really substantial.
So I'll walk through kind of actually tax planning for these changes and some actions that you can take. As I'm doing this, if you have any questions, feel free to post them in the comments. So, how should we approach these changes? You have some immediate actions. So, energy credits, like if you're planning that installation on a home, go ahead and get that done before December 31st. If you purchased an EV before September 30th, you would qualify for that EV credit. But if you've now considering purchasing an EV, you still totally can. If you think they look sweet or something, then go for it. But you won't get the credit if you bought it after September 30th. Tips and overtime planning. So the big thing here for overtime is probably going to be the most affected for those in the DPC space. But inside your payroll system, making sure you're using a system that is staying up to date with current legislation that has the support team to be able to implement these items. Because if you're withholding taxes on somebody's overtime that should be tax free, you're basically pumping money into the IRS that's a free loan for those employees when they could instead have that as a tax free income on the first part of their overtime. HSA planning, you can contribute with those new limits. So maximizing your HSAs if you are in a high deductible health plan. And then Trump accounts available starting in July of 2026. And if you guys are family planning, considering having a kid, the next few years, it's not a bad idea to have a kid because the government will give you an extra $1,000 in a Trump account. So maybe that's some planning opportunity there as well. For 2026, we're going to have that SALT relief plan for higher $40,000 deduction limit. That really is going to factor into how you calculate your quarterly estimates, making sure you're calculating what your state taxes are so you're not overpaying throughout the year with these changes. If you just kind of go with the base, I'll pay what I paid last year, pay a little bit more than I paid last year, you might be overpaying because these changes are taking effect in 26. And then business equipment, you get to continue that 100% write-off through 2030. So planning out your income and your business equipment purchases will help you be able to reduce your tax bill that way. Long-term thinking, long-term strategy, we're getting permanent rate planning, so being able to lock in benefits beyond 26, equipment timing, estate transfers. You guys have this higher exemption now, so if you are a high net worth individual, you can transfer money to your kids throughout your, the remainder of your life year over year. And so that limit goes up every year about 16,500 is the current year, but that is going to continue to rise to 17,000 and the inflation goes up. But you can give that without touching your exemption. But let's say you want to give a lot more. If you give $1 million to your kids in 1 year, your exemption of $15 million would now go down to $14 million. So you still have a lot of room. And what some people will do is say, hey, I want to use up all of my exemption now, or if that ever changed in the future, I want to make sure I lock in the higher exemption. And then think about Trump accounts and how you'll implement those. If you also have grandkids, talking to your kids about how maybe you could help them set up those Trump accounts to be able to get a similar to IRA effect for kids that don't have earned income. And then some timing considerations, act before 2025 on the energy credits, equipment purchases. You can do stuff now to be able to take advantage of your equipment purchases. And then income shifting, so considering timing with new rate structures on when you'll receive and transfer income, and then also your estate transfers. So this represents the one of the biggest tax opportunities in years. And so obviously, I'm sure you're going to have more questions or want to look specifically at your situation. You can go over to goodmancpa.llc/book-a-meeting, and you can schedule as a personalized assessment with Matt. He's on our team. He does these every single day, helps people kind of look at their situation and what strategies they could implement. And so you can take a look there, go to our website, learn more. We'd be happy to talk with you. We do have a question. Patients can pay DPC membership fees using their HSA fees starting 1/1/26. That is correct. The HSA application for DPC starts in January of 2026. Drew, did you have
Yeah, I'd
any?
like to welcome you guys to ask any questions that you have. It doesn't have to necessarily be related to this specific legislation change, right? Like anything related to your practice and the tax situation surrounding it. Happy to answer any questions there. We also have some AI generated questions that we can touch on as well. Nate, if you want to touch on those.
We've got. How about FSAs? Can FSAs, in terms of, could you clarify your question? How about FSAs in terms of can they pay for the DPC membership? While they're clarifying that question, Drew, I'll prompt you with some of these. So how soon should I start implementing these changes?
I'll jump back really quick to the FSA question. So it's not currently supported under the FSA right now. It's just HSAs, but I imagine that'll be coming down the pipe at some point as DPC continues to grow as a model. But right now, it's purely HSA only. You should start implementing these changes immediately, right? If, like Nate, you probably heard him reference earlier, don't let the tax tail wag the dog. And that just means that just because something is going to save you in taxes doesn't mean that it's always a wise decision. But if you're thinking about doing things, going back to the energy credits, right? If you're thinking about replacing the windows in your home or doing a renovation, or you've been thinking about adding solar to save on your utility bills, right? There could be additional benefit to accelerating that to this year. Things like the Trump accounts, I would definitely advise, especially if you have children that were born after January 1st, 2025. I would advise moving on those once that becomes an opportunity and July of 2026, just to get that free $1,000 growing for them tax free. And then whether or not you decide to contribute $5,000 to that account or not kind of depends on your personal situation. We have clients that we have employ their children, and in that situation, it could be more advantageous to do it that way. But if that's not something you're taking advantage of, the Trump account could be great. Um, some of the other things will be kind of benefiting you automatically, things like the tax rate. The tax rate's not increasing and the standard deduction, right? Like your CPA or whoever you're working with should have all of those changes factored in for you. You'll start receiving benefit on those as soon as you file your 2025 tax return. But those changes should be factored into the estimate calculations that your CPA is doing for you now.
And then another one is anything can go towards a deductible for DPCs. In terms of the deductible, I'm assuming you're asking, can we deduct DPC membership fees considered as a medical expense, not can it count towards a deductible for your insurance? Because most people aren't going to use it that way. So in terms of it being a qualified medical expense, yes, as long as it's a fee for access for medical services. Anything that is considered administrative fees and non-medical amenities would not be considered a deductible medical expense. So if you have things that you're doing that are not medical, um, you would want to create a list of those services and probably for like administrative ease I would bill those outside of the monthly fee just to make it more administratively easy. But most of the doctors that we're working with, things are prescribed by a doctor. They're aesthetic services as well. And so we can qualify most of those under a medical expense because it's being issued by a doctor, requested or prescribed by a doctor. I'd love to give another example. So, like, if let's say, Drew, I'm a DPC and I'm an S corp, how does the 20% pass through deduction affect me?
Yeah, so assuming that you fall below the SSTB limitations, those income limitations that would keep you from, starting to phase out the benefit of that deduction. Say you had $100,000 in ordinary income from your practice this year, you would be able to take on your individual tax return a deduction for $20,000. And it's kind of an automatic. There's an optimization that takes place that your CPA will need to make sure they're aware of, but it's something that you automatically qualify for just by being a small business owner. So on that $100,000 of net income, you could take a $20,000 deduction.
I like this one. So, can I use the car loan interest deduction for my practice vehicle? And that one specifically, since if it was a practice vehicle, like it was owned by the practice, that's already been considered deductible. The car loan interest that's being considered is personal car loan interest. That would be through your itemized deductions. But if you have purchased a vehicle for your practice and there's interest on it, it's considered business interest. And so it'll be deductible. There are limits, but for most people, those don't come into play unless they have more than $1 million or $5 million in interest. And then another one, can I still contribute to an HSA if I'm on like a Christian healthcare cost sharing plan or a Sedera health share plan? And the answer to that one is going to be no. You do have to be participating in a high deductible health plan to be able to qualify for contributing to the HSA. So I think that's it for today. If there are any more questions or you guys would like to reach out again, feel free to, you can contact me directly. We have a mission as a company to help see the DPC community succeed and build sustainable business models because you guys are at the front end of changing healthcare in America. And a lot of doctors that we interact with, whether they're counselors starting a counseling practice, dentists, or primary care family medicine physicians that are starting these practices, a lot of them tell us, "Hey, I started this, but I'm trained to be a doctor. I'm not trained to be a business owner, and I have a lot of questions." And that is a great place to be to say, I want to ask those questions and learn more and grow. And so that's where we want to come in and help say, hey, what does it look like to set up a QuickBooks Online account and keep track of your expenses? What does it look like to plan for taxes so you don't get stuck with a big tax bill in April? Um, but we also talk about pricing. How would you price your services? How do you structure and measure your marketing success to make sure you're not just throwing money into a black hole? All of those things we love to be able to work with folks on. And the way our services work is the same as yours. We have a monthly fee, so you don't feel this burden that you're going to get billed every time you talk to us. We want to work just like you guys. And when people interact with their healthcare professionals and they're there more often, the end result is better health outcomes. And we're seeing the same thing. If people will interact more with their accountants throughout the year, they end up having a better tax and financial position. So if there's ever a point that we can help you guys along your journey, I'm always available to help with questions. We do offer those assessments for free. It's no additional cost. And so we'd love to talk more about where you guys are at and the direct primary care model that you're in. With that, we'll say goodbye. Thank you so much for joining today. If you have any questions, feel free to reach out. Thanks, everybody.